Now, while discussing the nature and likely benefits of sustainable finance, it's also healthy to consider some of the challenges and criticisms related to the sector. Despite its potential benefits and growing importance, sustainable finance does face some legitimate risks, challenges, and criticisms. Now, first and foremost is greenwashing. Now, greenwashing is a term that many of you will be familiar with as it's getting more and more attention. Greenwashing happens when a company, a government, investment product, or really anyone else overstates or exaggerates their environmental or social impact. Now, basically, they fabricate or exaggerate to make something seem more green or sustainable than it really is. Now, this can mislead investors and customers or other stakeholders and rightfully undermines the credibility of sustainable finance initiatives. Now, another challenge is that there is currently a lack of standardized definitions and reporting in the sustainable finance sector. Now, that's quickly changing, but it will likely be a problem for many years to come due to the complexity and size of our current financial systems. Now, why is this a challenge? Well, the absence of universally accepted definitions, metrics, and reporting standards can create confusion and inconsistency in the market. So as you imagine, investors may find it challenging to compare the sustainability performance of different companies or investment products. Or corporate leaders may have difficulty knowing what standards to even follow when creating their own internal financial systems. Now, similarly, uncertainty in terms of regulations and policy is slowing adoption of sustainable finance practices. Now, while there has been progress in developing regulations and policies to support sustainable finance, inconsistencies across jurisdictions and the ever-evolving regulatory landscape can create challenges for market participants. And the lack of consistency in terms of regulation leads to yet another challenge: limited data and transparency. Now, companies often don't really disclose sufficient data, or they may provide information that is difficult to verify due to the lack of regulatory clarity or consistency. So in turn, this lack of transparency can hinder an investor's ability to make informed decisions and accurately assess the sustainability performance of their investments. Now, assessing the real-world impact of sustainable investments can be complex and challenging. It can be difficult to establish a direct link between a specific investment and their environmental or social outcomes, making it really, really hard to quantify and verify their impact. Or just to put it more simply, it's easy to call something a green or sustainable investment, but we need a way to actually measure the outcomes and share that data transparently so that it's clear what projects and companies are worthy of investment and which should be avoided. Finally, it's hard to fully integrate sustainable finance principles across all sectors so long as we emphasize what is typically referred to as short-termism in our business models. Now, sustainable finance aims to promote long-term value creation, but the finance industry and really our current business teachings in general often focus on short-term gains. Now, this short-termism can hinder the integration of ESG factors into decision-making and impede the transition to a more sustainable economy. And that focus on short-term profit generation stems from potentially outdated fiduciary models. Now, what I mean by this is that some institutional investors and asset managers may perceive that incorporating ESG factors into their investment decisions could conflict with their fiduciary obligation to maximize financial returns. Now, this can hinder the widespread adoption of sustainable finance practices and is why large fund managers like BlackRock and many others have gone out of their way to inform their clients that they are going to take a more long-term approach to investing client funds. Now, while these challenges are real and significant, they can be addressed through ongoing collaboration among stakeholders, education, the development of standardized definitions, reporting frameworks, and the adoption of best practices. Now, the continued growth and maturation of the sustainable finance market will also help mitigate some of these risks and criticisms.